Oh boy. Oh boy. The Fed has saved the stock market multiple times ever since COVID happened, and they refuse to allow the stock market or the economy to crash. The reason why I say economy with quotation marks is because there are many jobs lost. This is a fact. However, the Fed, by printing more money and allowing more people to pay for bills when they're actually buying stocks. Hey, in today's video, we're going to talk about what to do with your money right now and why it is extremely important to take some actions in the near future, or at least understand what exactly is going on. My name is Anthony Pietrobono. I'm interested in personal finance and investing, and on this channel we talk about stocks. I share my portfolio updates, and we talk about how to essentially save more money and get closer to building our net worth so we're able to achieve financial freedom. If you're interested in that, then consider subscribing. All right, so that Federal Reserve, what have they done? What have they done? Well, they saved us, right? They gave us money. Okay, they printed trillions of dollars out of thin air. What does that do? That puts more money in the economy. And then you're thinking, that's great. Well, whenever there is more of something, what happens? The value of it decreases. This is part of the reason why we are seeing some stocks do exceptionally well. It's a two-part reason. We see some stocks doing very well, and we see some stocks, like the cruise lines, the airlines, and the financial industry, like the banks. We're seeing that they took a big hit, and they didn't really recover yet. However, the tech stocks and anyone with innovation, they took a big hit off the start, and now they've surged up to new highs. How are they in new highs when there's tons of states in the US and countries all still on lockdown where people aren't even allowed to get back to work? Why is this happening? How is this happening if the consumer isn't spending as much money? Well, the stimulus money that are going to people, they're not spending as much money anymore. So they're getting these stimulus checks. What do they do with the stimulus checks? They put their money in the market because they have extra money and they're sitting at home and they're researching stocks and they're learning about stocks. So they have more time to learn about these things. That's the first part. The second part is the pros and all the wealthiest people are putting their money in the markets because they are fearful, extremely fearful of inflation. This is the reason why we must be investing or putting our money into some sort of asset in the real near term. Because again, this is what all the wealthy are afraid of. They're deathly afraid of this right now. And that's why we're seeing the markets still up. When there's more money, money is worth less. So what do the wealthy do? They put their money in and get it working for them. They're holding less cash because they're fearful of the inflation. We've never printed this much money before. So what can you expect? We can expect to see unprecedented times of inflation. Things costing more in the next 3 to 5 years. We can expect this. We can expect taxes to increase to try to get money back. These are things we can all expect. So what do we need to do to protect ourselves? We need to be investing now more than ever. Don't take this video the wrong way. Don't think, okay, I need to pour my money, all my dollars in right now. That's it. Anthony says put money in the market. I need to pour my dollars in. No, we don't rush to do this. We want to do this with the right approach. We still want to have some sort of a timing, right? We may not necessarily want to buy stocks at their all-time highs, right? We want to look for deals. We want to look for stocks that are 50% off. I highly suggest, if you haven't read the book yet, read the book by Phil Town. It's called Rule Number 1. And he takes Warren Buffett's investment philosophy where you essentially want to look for businesses that are 50% off. You want to look for those businesses that have taken the hit, but you also want to do your due diligence to ensure that these businesses that took a hit, they're not going to be permanently beaten up by the current circumstances. We want to find those in-betweens. What are the stocks, what are the businesses that they're not necessarily at their all-time highs? They might have took a small dip, but they have new innovative strategies to go ahead and build themselves back up in the future. Or what you can do is you can go ahead and, if you're unsure, you can go ahead with the diversified approach and you can buy the overall market. You can buy the S&P 500. You can buy all these things that are going to be encompassing all the greatest, largest companies. So that way you're just taking a piece of that steady growth. None of this is exact financial advice. I don't want to point you in the direction of a specific stock. I want you to understand that your dollar and my dollar is worth less in the next 3 to 5 years. It will be worth less at an accelerated rate compared to previous times. This will be unprecedented in the amount and the rate at which things are going to cost more, meaning our dollar will be worth less because of the fact that we've never had this much money printed ever. It's insane. Yes, it was necessary because we had to make people feel safe so they could pay bills, but there's just so much money that got poured into the market, into the economy, so that now our dollar will be worth very little as we go through the next years. So now is a time more than ever to consider investing. I hope you enjoyed the video. I hope you found some value in this. Remember, take time, invest in yourself, invest in your knowledge, your skills, and your assets, so that you're able to go ahead and invest in stocks and real estate or your business to achieve that financial freedom. Please give it a thumbs up if you enjoyed. Subscribe for more finance content just like this, portfolio updates as well, and I'll see you in the next video.